Thank you, David. It's wonderful to be here. I wasn't exactly sure what kind of the other presenters, what kind of content they were going to be presenting, but I think what I have for you today falls in the line of what the kind of general style of presentations. We do Elliott wave analysis at ElliottWaveTrader.net. I run the stock waves service as well as the metals, miners, and agriculture service. Along with Garrett Patton. And we also contribute as our contributing analysts to the broad markets service, as well as some of the other services we chime in and are just part of the overall management team. We also replicate our stock waves and metals and miners service on the Seeking Alpha marketplace. So you can find us there. I also share some stuff on Twitter at Zach Mannes. That's just ZACMANNES. So what I have for you guys today is kind of a very quick down and dirty run through of the absolute basics of Elliott wave so that we can talk about some other things. I wasn't planning, because this is geared towards technology and technical trading, wanted to kind of show how we use some of the other tools in conjunction with Elliott wave. But wanted to make sure that everybody has at least a very, very basic understanding of the general concept of Elliott wave, as well as the improvement upon it that Avi has brought to the world of Elliott wave in terms of Fibonacci PinBall. All of the stuff that I'm going to talk about here in the first part is available for free at ElliottWaveTrader.net under our education section. There's a number of free articles and some webinars and tutorials on what Elliott wave is and how to use it. So I'm going to kind of work off of there. At the very, very basics, it is a fractal system for putting investor sentiment extremes of fear and greed into a context with some labels, and then project that forward. When we say fractal, that means that each smaller piece is a similar part of a bigger whole, or you can delve down at smaller and smaller levels and see the exact same patterns unfolding as the different parts of those larger subwaves. So the very basic structure is a 5-wave move, usually to the upside when we're talking about 5 up and 3 down, and a 3-wave correction. And usually those are used as a nomenclature as 1, 2, 3, 4, 5 for the move to the upside. And the most general term and most simple correction is an ABC correction to the downside. Now, when you put it together, that same 1, 2, 3, 4, 5 and ABC down can be the subwaves inside of the same 1, 2 of a larger structure. Or maybe the 1, 2, 3, 4, 5 is the 3rd wave of a larger structure. So that's how we look at the fractal aspect. And then to see what exactly it fits in, that's where we're zooming out. We're looking for a very large degree low as a common starting place, and comparing it to other charts. And we'll work on building a chart from the ground up using the S&P in just a minute. But what I wanted to move on to from just this very, very basic structure, and again, I know this is kind of a very fast crash course, but there's a lot of other things that I wanted to get to. And, again, we have a lot of other articles and webinars that are available for more in-depth introduction to the rules of Elliott wave. I highly recommend the Elliott wave principle. That's the book by AJ Frost and Robert Prechter. It is pretty short, and some people, it's very much like, sometimes you have to read it 2 times, but when you get it, it just clicks and you get it. And there's a lot of stuff on there about Fibonacci and fractals and nature and things like that. So it's not all a dense textbook on Elliott wave. So good stuff to take a look at. But the other thing that I wanted to talk about is the Fibonacci PinBall. And this is so all of these wave patterns, the different parts of the wave are usually related to each other in terms of Fibonacci ratios. And we know that usually the third wave is going to be 1.382 times or 1.618 times the measure of wave one. But sometimes it's hard to differentiate when you have this structure and this structure to know, should you be expecting a wave three, or should you just be expecting a C wave up, a measured move? And so that's where looking at the smaller degrees and the subwaves is going to help give us clues along the way as what's unfolding and what we should see as far as all of those patterns inside that move. So this is where we have a Fibonacci measure. We have an initial move up of 5 waves up to the upside for a wave 1 and a 3-wave consolidation as a wave 2. Then this blue Fibonacci extension is the measure of wave 1 extended off of the low that we think we have for wave 2. And that's going to give us our target for the wave 3 of the 1.382 extension, and then further for the 5th wave. But what I want to focus on is inside this wave, and we're going to look at this in more detail on some real price charts, is that our wave 1 inside that wave 3 is going to first go to the 0.382 extension. Then we get a normal wave 2 retrace. The wave 3 is then going to go to the 100% extension, and then a normal retrace for the wave 4. And then we get that 5th wave of inside the 3rd wave to that 1.382. That is the most common version of Fibonacci pinball and what we see with alarming regularity. So much so that when we don't see a clear, smaller 5 waves up and 3-wave pullback to that 0.382 or the 0.50, or maybe sometimes the 0.618, if instead we see a move that heads past it, either to the 764 or to the 1.0, then we know, all right, we have a strong move. Maybe there's some continuation of the pattern, but you don't have that reliable 1-2 start to a 3rd wave that you can hang your hat on and continue to project forward. It means that you need to start looking for something else to be playing out. Maybe that's a more muted measured move and you're going to turn back down and make a lower low, or just something else is going to be playing out. So I could spend a lot more time talking about fractals and Fibonacci pinball on education slides, but I'd rather move over to an actual chart and kind of start building that up from there and show you some of the other tools that we use in addition to just those fib markers and the Elliott wave labels for getting some confirmation as to what we're seeing and looking to how to use that in a predictive way. So let me switch screens here to a different window. So what I want to do, I have an SPX chart, and I kind of wanted to, you guys are going to get some freebie glimpse analysis of where we see things in the S&P as we're kind of doing this exercise. And so I wanted to zoom out and just quickly kind of show, a larger degree Elliott wave count off of that 2009 low filled out, where, most of that move looks like it's complete. And that's what we're going to start building together in a starting from a common low that we think, in a larger degree count, zooming out even further. And you could keep zooming out, if you have the data that goes all the way back to the 1700s to the very beginning of the New York Stock Exchange. But for the most part, for what's applicable to traders, it doesn't make sense to go that far. But I do think that it's important to have a really strong context of where you are at a larger degree, because it does affect the risk reward. So while Elliott wave is fractal and you can zoom into a micro chart and look at 5 minutes and trade off of that, sometimes things tend to start gapping in one direction really, really fast. And it is very helpful to know, where things are at a larger degree so that you can understand that risk skew. So I know if I'm trading something to the downside, I know that the broader trend is really up, at however many degrees, the trend is up. So even if I'm looking, if I have a very clear small degree setup for a scalp to the downside, I understand that the risk skew that at some degrees that is counter trend to what the market really wants to do. So as I was saying, I think the best thing to do is to start off of a very significant low. And again, when we're talking about context, we could say, well, March 2020 was a pretty significant low. And it is. And for the past, year or so, 2 or 3 years, we've been looking at most things off of that low because we've been counting that as a pretty significant primary degree wave 4 and have been looking at the wave 5 unfolding off of that. But if we're going to zoom out even further to get more context, then I think it's helpful to start off of that 2009 low. The software that Garrett and I use and some of the other analysts, we continually try to get Avi to migrate away from TradeStation to Motive Wave, which is the software that we use, because for people that are tracking, that are using Elliott Wave, I think Motive Wave really makes things very, very easy. I don't use the auto counting. I have not found, I don't even know where it is on in my toolbox here, because I found that it really, no software, I mean, I want to be careful in saying that there's so much nuance and subjectivity to Elliott wave counting because there are very clearly defined rules, but part of the rules are that things have to have the appropriate look. And so there is sometimes a subjective judgment call from the analyst that, computers, even with machine learning, still are not able to replicate in a good way that we would correctly say that that's a good count. So one of the things that I like to do, I have my Elliott wave tools. Those you can get to them from a couple of different places where you go to the different tools. So this is under Elliott wave. This is the regular impulse tool. I have a shortcut to it here on the left. And so we can just draw our initial 5-wave move, starting with the big movements here that we see. And I'll tell you why I'm placing these in different places in just a minute. But we'll start with, let's get rid of that cycle degree wave 1. We'll start with this for right now. This really looks like a 5-wave move to me. 1, 2, 3, 4, 5 off of the 2009 low. And we're gonna, you'll see that on that other chart, I had a little green 5th wave floating up there that allows for a higher high. And we'll take a look at that potential from right now. But at the end of the day, I think it's important to see from that broader context that we can see 5 waves moves here, a 5-wave move. But before we look at the rest of that move, let's just start with what we have off of the low, and we'll pretend that this is back in, sometime circa 2010, July 2010, and we'll say that we can count a impulsive looking move that whether you count a little 1, 2 here or a bigger 1, 2, and then a smaller 3, 4, 5 up, we can count this as a 5-wave move off of the low. So we can draw a Fibonacci. First, let's start with a retrace tool. So this is just a Fibonacci retrace tool that we have measuring from the start of that 5-wave move to the top of the 5-wave move. And we'll go to our retrace purple, and we can see that we have a pullback here that did not hit any of our ideal Fibonacci retrace zone. We know that one of the guidelines for Elliott wave usually is that the ratio of a wave 2 is going to be somewhere between a 38.2% retrace to a 50% retrace to a 61.8% retrace of wave 1. So that's our ideal target zone. That's, the Goldilocks target, but we don't always get that. So at the time, we were probably looking at this being just the A wave, and we're wanting to see maybe a wider flat play out. So maybe an ABC move to the upside. Oops, where did that go? There we go. An ABC for a B wave to the upside. And then ideally we would want to have started to see some weakness after looking for this move higher from that initial drop, looking to see some weakness in the start of a move down. When that got further extension and made a new high, then we would probably say that the probability, while that could have been an alt extension, we probably would have switched this at the time to looking for that as a wider flat as a potential risk, but looking more for any consolidation to be a spot to add on. So this is where, again, we're looking at the broader context and we're saying, okay, we think that this is the start of a bigger cycle degree move to the upside. We have a 5-wave move. We have an initial retrace. Ideally, we'd like to see more of that retrace, but we don't always get the ideal. So then we say, okay, if that is all of the consolidation, then we're looking for the Fibonacci PinBall from there to give us confirmation that this was all of the wave 2, and it's the primary degree wave 3 starting. So that's where we draw our Fibonacci extension tool. And again, it's the measure of wave 1. So the start to the top, and then projected off of the potential low for that wave 2. And again, here where we're looking at the risk, when we start to evaluate from here, the Fibonacci targets for which at the time would have been here would be the ideal target, 1382 to 1618. We actually got more extension than that. We'll talk about that in a minute. But when we're evaluating for risk reward purposes, we're saying, okay, at this degree, we could still end up getting more of a flat consolidation for wave 2, but that's going to still hold at the time, the 960s, 970 would be the ideal support. So we're still, the projection for this larger degree wave 3 is not going to be much different whether this is the wave 2 or whether the wave 2 gets moved over to here. So at that larger degree, we can start to make those calculations, and then we're looking for confirmation at a smaller degree. And again, it's fractals, so you can continue to zoom in at each and every level. So now we know that based on the Fibonacci PinBall that we looked at before, we want to see a 5-wave up move to either the 0.382, the 0.50, or maybe the 0.618. And when we look closely, we have what was initially only 3 waves up, then got higher than it should have for the B wave, then held a consolidation and pushed even higher, and then got another consolidation and a little bit higher than that. So that can be 5 waves up right to that 0.50 extension. And we can call that the intermediate degree wave 1. So if it'll let me add that here, let's move this out of the way. The intermediate degree wave 1, that's in parentheses inside that circle wave 2. So that's a 1, 2 right there. And then we can say, okay, Fibonacci PinBall is going to say we should head to about here for the 3, and then here for the 4. And then our 5th wave of the circle wave 3, at the time, this is what we would be projecting. We'd be looking for a normal retrace, maybe to about right here, and then the 100% extension, a pullback, and then up to the 1382. So this is what we would have been looking at the time back there in early or mid summer of 2011, looking for an ABC retrace after this 5-wave up move to the 0.50. We did get a 3-wave drop, and then we got a little bit extra into that November low, but we still managed to hold a higher low, even though it was under the ideal Fibonacci retrace. But probably some of those first attempts, off of this low here, some of those first attempts might have gotten stopped out unless you were being, if you were looking for a smaller degree start to the move there. Then we got a little bit of a nested start. This was not the cleanest 5-wave up structure. It looks more, in hindsight, looks more as a 1, 2, 1, 2, maybe even a 1, 2, but we can count this whole thing as a larger wave 1. But then as we continue to progress in this move, we ended up getting further extension past the 100% extension. continued up, and then held another fourth and a fifth wave into here before we got what looks like an ABC consolidation for our fourth wave. Then from there, since we already got to the 1, 2, 3, 6 extension for the parentheses wave 3, then after we filled out this wave 4, we knew that our fifth wave, our parentheses wave 5 of that circle wave 3, was going to be targeting at least this region. And so then when we got this initial move off of the February 2016 lows into, I think this is the Brexit. We were looking for a drop on the Brexit news. We were counting that as a 1-2 start, just the 1-2 start to a much more extended fifth wave. Another tool that I like to use in Motive Wave is the decompose. Again, I said I don't like to use the auto counting feature because I think it's often wrong. But once you have 1 degree of a label there, then you can click on that line and you can go to decompose and you can say, all right, decompose that as an impulse. Again, it doesn't always put things where we would put them. So we're going to move this 1, 2 over to here. And then again, we can say, all right, this, we know where this would be targeting. Forget about where it's putting these labels for right now. We're not concerned about that. I'm going to zoom in just a little bit more so that we can focus on this part of the move. We're going to decompose again and say we're looking at this as a 1-2 start off of that Brexit low for more of the fifth wave inside the third. And so again, you're just going down to that fractal level and using the Fibonacci PinBall and saying, all right, here's the measure of the move that we expect for wave 5. We know based on the larger degrees where it's going to target. And then inside that move, we know the approximate ratios of where those different subwaves should target. And that's when we also start to look at those different clues as well. You know, I have here on the bottom of my charts, I have MACD, RSI, and a version of stochastics. I like to look at those at different time frames to get to see where they're hitting some extremes and how that's lining up with the Elliott wave count. You know, if we're seeing some positive divergence as we're expecting an ABC move to bottom, then even though we want to see confirmation at a smaller degree before, you know, fully committing to a move, you know, we can say, all right, we have a measured move for a C wave that's nearing completion, and we're starting to see some signs of divergence in the MACD, for example. A couple of other tools that you'll see on a lot of the charts that I post before we get into going to the rest of that pattern there is one of the things that I like to use is Fibonacci fans. These help provide an element of timing and of just momentum for different than just a regular channel for price to follow. So, you know, Elliott wave does work, you know, a lot of times likes trend lines. You can draw, you know, trend channels and see, you know, something, all of the higher lows and all of the higher highs are kind of fitting within a channel, and you can use that for a period of time. But I think the really nice thing is that all of those different tools that we can have in our toolbox, the understanding the Elliott wave and being able to provide some labels there with a broader context helps you say, okay, this looks like it might be an inverse head and shoulders, or, you know, whatever it is that might be filling out. But it gives you the context, is that this inverse head and shoulders here, is that a reliable bottom for all of the primary wave 2, or at the time, can we trade this as an inverse head and shoulders for a swing to the upside, but say at this point, our bias needs to be that whatever upside move we get is going to run into resistance around here, because the normal pattern, the most reliable thing that we look for, you know, and again, we're assessing things based on probabilities, would be for this to be part of a wider consolidation for that big circle wave 2. So we can trade based on that inverse head and shoulders pattern. We have a move off of a low and a corrective retrace into some support. So we can at least look for that measured move but knowing that it might not last and head be the breakout move at the time until it gives us more data from there. So we can trade for that swing, and then maybe we trim out and exit some of that and hedge for some potential start to a weakness, or we can just continue to raise our stops as long as that's a winning horse. Those, we're a lot of time, there are some of the services that we offer at ElliottWaveTrader.net that are giving you some specific trade ideas. But for the most part, we are looking at analysis and assessing risk reward for those different scenarios. We're going to have a bias in trying to use Elliott Wave for predictive measures, but we're and might talk about some of our own personal trades. But for the most part, we are looking at it as a form of analysis that we can provide to you guys. So filling in the rest of this, after getting further extension, none of these consolidations were breaking any kind of support along the way. So we could continue to call this just the third inside that parentheses wave 5 of the larger third. And here's where we get to something that's a little bit complicated. This is not your standard ABC retrace. We have an initial ABC down, and then a move that's very similar to what we saw back in 2011, where what should have stopped, somewhere in resistance here is just a B wave bounce and then headed lower for that circle wave 4, continued to march on higher and then held a pretty high retrace and then continued to march on higher. So at the time, we had to start to consider the potential that this might have been all of the wave 4. It did get to one of the Elliott Wave guideline initial region, as far as a minimal amount of retrace, but it really did not even look, this primary degree wave 4 is a larger degree magnitude correction than this intermediate degree wave 4 in parentheses 4 inside that primary wave 3. So this rubbed me the wrong way as being counted as all of the move, but because we didn't turn down after the bounce that we expected and continue to start higher, then we had to look at other things playing out. And that's where, Garrett and I are going to start diving through a lot of the different sectors in stock waves in individual stocks and trying to see, all right, where's the strength coming from? What can continue to show strength? And what are the things that we need to be on the lookout for weakness? And one of the things that we saw that was very, very weak as we continued to tick higher in the market overall into December and January, December 2019 and January 2020, we were really concerned about the financial sector and a lot of the XLF names that we saw very clearly looked like this was still a corrective B wave, even though it was exhibiting some characteristics of the start of a bullish Fibonacci PinBall move. So we were, showing very clearly where support would start to break or would need to hold to maintain any more aggressively bullish structure as the start of that fifth wave off of this low. But also showing where the major risk was for things that very clearly counted as though this was a B wave high. And then once we got initial gap down and then there wasn't any kind of relief rally and it continued to break some higher levels of support, and then it went on to accelerate. So that was how we were very well positioned for the COVID drop. But after that, it filled out right to the support region that we expected to hold as that wider expanded flat for the primary degree wave 4, which had us very, very bullish from those March lows, and particularly when we held a higher low at the beginning of April off of the COVID lows, looking for big swings to the upside. And that's what I want to zoom in on now and build out the subwaves inside that primary wave 5, which very possibly topped. And we'll kind of take a look at what we were looking at going into the beginning of 2022, and then how things filled out from there. So again, we were very, very bullish off of the low, wanted to see what looked like 5 waves up and then more of a retrace. We got an initial, what could count as 5 waves up into June. And so from there, we're going to call that our wave 1. I'm going to do that is the impulse again. So we have our 1, 2, 3, 4, and 5 waves up here, 1 degree larger. And that looked like it should have been wave 1 at an intermediate degree. And the ideal retrace would have been somewhere around there. And then we can look for our Fibonacci PinBall. Oops. There we go, at that degree. So this is what the ideal structure would have been inside that move. But we did not get, again, very similar to what we talked about before, we got a sharp initial drop, which in an ideal world would have been just the A wave of more of a normal size retrace, and would have been looking for a B wave bounce. And then the second half of that corrective consolidation into the more normal Fibonacci support zone. And this is another tool that MotiveWave has that I like to use a lot. You'll notice that, I know that you probably see a lot of Elliott Wave and analyst charts that have tons of these bigger colored fib extensions and retracements drawn all over the chart. I find that gets very, very confusing to try and isolate what the Fibonacci tool is trying to measure. So I do a lot of things with color coding. And with I try and keep things as simple as possible. So I use this localized Fibonacci tool where it says 2 versus 1. That is the retracement of this wave 2 relative to the measure of wave 1 off of this March low here. So it snaps it in place at the highs and then automatically recalculates that. If you move your wave 1 to a different top, then it recalculates what those fibs are going to be. So our ideal retracement level, at least the top of that ideal zone, we mentioned the 38.2% retrace, the 50% retrace, and the 618 retrace as that Goldilocks ideal zone. So again, with the prudent approach would have been to assume that you could bounce higher in the B wave, but that you were going to run into resistance here. When you held a little bit and then continued to start to march higher, that's where we had to say, all right, well, maybe this wider flat for an ABC is now an alternate. And we can start to consider that even though this is only a 23.6% retrace, and at the beginning, as an initial drop, it's not reliable as all of that wave 2, we can start to project what that would look like off of that low. So from there, our localized fib tool would say that we'd want to see a third wave ideally come up to the 550.75 region, hold as a wave 4 retrace, and then get a 5th wave up beyond that, maybe close to the 6,000 region. So in the most aggressive count, if this was all of the wave 2, this is what we were looking for. And I made a tab. You can see these tabs at the top of my chart. I named them different things. That's what I started calling the Uber accelerated bullish count, where started to consider that this was going to fill out. And again, we have a measure for a wave 1. We have a Fibonacci extension projected off of the wave 2. And so we can pull our fibs down and we can say, we know that wave 1 inside the parentheses wave 3 should target somewhere in between this 382 to 0.50 region, which we can see that this move up here came exactly to that 50 level. And so that's what we were looking for as a wave 1. We wanted to see a retrace as wave 2, and then the rest of 3, 4, and 5 play out in that more accelerated bullish path. And so we got the first part of that. Then we got what didn't look like 5 waves up off of that low, even though we had enough to count for all of it. So we easily say, all right, this could be all of the wave 2, but we don't have a clear impulsive start. We don't have that 5 up look that we want to see. So while ideally this was all that we got for wave 2, we might say something like, this could be a smaller B wave and it tries to fill out as a wider version of that same wave 2. So because it came nearly up to the higher high, it shouldn't get much deeper than what we already got here. but could retest that region again. We didn't actually make a lower low, so that's up for debate whether you're going to count this as not quite 5 waves up for the next smaller degree, wave 1, or just count this as a wider flat. That's again where you get into some of that nuanced difference between analysts of what might be subjectively looking a little bit better to the next, and so forth. So from there, we continue to march higher, never breaking any kind of support at any larger degree, and continue to fill out those subwaves. I personally think this is where the wave 2 looks better as a running flat, and that this is the even smaller degree, wave 1 and wave 2. At the time, this looked good for all of a wave 3 into the 100% fib extension right around here. But we didn't get very much for this wave 4. So because we didn't get very much for that wave 4, we could look for more extension of this wave 3, and then maybe count this as the wave 4, and then looking for a little bit more extension as wave 5. And then again, I'm going to put this here as this is the more aggressively bullish version. So we'll make that in blue. So by this point, we hit a 1, 2, 3, 6 extension. So even though we could count enough subwaves, it really looked better at the time as though this was still just the minor degree, wave 3. And I'm going to move this big circle, wave 5, further out of the way over here. It looked like this was just the minor degree, wave 3, and that because we were all the way up to the next fib here, the 123.6% extension, that it should push the 5th wave of that parentheses wave 3 up to the next fib, that 1618 fib, provided we hold support for a wave 4. So we were bearish, looking for a consolidation as wave 4 into the beginning of the year. Actually, I was really starting to get more bearish here back in November, and was noting a lot of divergence, even though the market was making a nominal higher high over those November highs. A lot of things, one of them being financials or the NASDAQ in particular, was making a lower high at this point as what looked like a corrective bounce off of this high. So that was where we were able to be very concerned for at least some degree consolidation, bigger than any of the consolidations we had since earlier in 2021, certainly at the beginning of the year. So we did get enough of a drop to easily count as all of this wave 4. Didn't quite fill out the ideal pattern as far as 5 waves down in a C wave though. So while we were looking for at least a bounce, we could give this the benefit of the doubt because it looked pretty impulsive off of there, that this was the start to the 5th wave. So if that's the start to the 5th wave, we would want to see 5 waves up and then a corrective retrace. We didn't quite get much in the way of any kind of 4th wave to get 5 waves up. So we could start to look for some other alternate patterns where maybe the subwaves are all ABC moves. It's called a diagonal. Again, I'm not going to get into so much of the nitty gritty, but once we started to break initial support for what could have been a 4th wave or even the start of a wave 2 in a corrective retrace from this move up into March that we were expecting, that nice swing off of support here, this point, particularly this drop at the beginning in mid-April, was where this looked like a decent start to a bullish swing, but this was where things started to break down and we started to look for alternative levels of support. And if those weren't going to hold, it was likely that we were going to continue to head lower. So once we broke under, we have some guidelines for where a normal 4th wave should hold at a given degree. And once we extended below that kind of normal reliable support region, it started to get more probable that at least this was, we needed to move these things back a little bit. And even though this only got to a 123.6% extension, this could still be pretty uber bullish and head to a higher high, but that we were looking at this as a larger degree, intermediate degree wave 4. After it filled out the larger A, B, and C wave drop down with 1, 2, 3, 4, 5 waves down and a C wave with the extension that it got into the June low under May, and could restart a bullish count from there, still heading to one more higher high. We got a pretty nice move off of that low. There were a lot of wave setups that Garrett and I posted in stock waves at the time. That headed up very nicely. And again, we didn't quite get a clear 5 waves up. We only got 3 waves so far, and wanted to see that hold as a 4th and then get a higher high. It pulled back is what we would like to see for a 4th wave. But then when it started that move up and then broke support, we said, okay, maybe this is only an ABC wave up. And at the time, we were not looking for this to be so bearish in terms of a big measured move to the downside at a larger degree, but we could at least see more of a retrace as a bigger corrective retrace into support. And we got that and held, I think this is right about a 618 retrace, and then got another really nice strong move off the low. But when we were looking for that to start to consolidate and hold a higher low, it gapped down and then went on to start to break support. And once it broke under that, we had to look for more extension to the downside. And so at the time, that's when we started to look for some good short opportunities, some additional short opportunities of things that if the market were really going to start to fall apart, could benefit from more of a downside move. We did go on and make at first a nominal lower low and then a spike in October as a more actual lower low under what reliably counted as wave 4. Now, in terms of ways of counting this 5th wave, at this point, I think moving over the 4th wave over here is such it relies on so many kind of alternate ways of counting from what the normal structure is. It's so big in magnitude to the wave 2, and it is so easy to come up with a more completed count by just scooching everything over and having it complete smaller 4th waves that were not reliable to count as that larger degree 4th at the time, but into a more significant top with 5 waves down off of that high. So that's where we find ourselves right now, with what looks more like the top in place, still the potential that maybe this was a 4th wave, and we're going to try and eke out a nominal higher high. Garrett, a couple of weeks ago, Garrett and I put out a list of some large cap names that make a better argument for actually succeeding in getting higher highs over that November to January period about a year ago. But not a lot of those are not the strongest charts in terms of percentage gains, or even the strongest charts in terms of clear wave setups that we see. A lot of the things that look stronger are set up more for at least just this C wave swing move, a measured move off of the recent December low as a C wave in what is most likely to be part of a corrective bounce. Now, the NYSE, the NYA, as well as like the RSP is something I like to track that's an equal weight version of the S&P. Some of those do more readily allow for actually reaching a higher high, but that's not the higher probability part of the move. I think when we focus on risk skew, it's important to look at this in terms of, at a much larger degree, we have a very, very big 5-wave move up that completed off of 2009. That itself can be a larger 5th wave of completing an even larger super cycle degree wave 3 that might go all the way back to the 1930s low, which was the corresponding super cycle degree wave 2. So we have a lot of reason to be far more cautious in terms of upside expectations here, while still being able to assess things on a fractal basis and zoom in and say, okay, well, from right here off of the December low, we have a really strong looking setup for a swing move higher, even if that is part of a bigger corrective bounce that is then going to turn significantly bearish, probably right around the time most people start to become more bullish, than they are now. Particularly if we get all the way up towards the 4,400 region. At that point, there's going to be a lot of people clamoring for continuation of the strength to new all-time highs, which it might actually do, but I just don't think that that's the reliable portion of the swing. Before I jump in or jump over and take some questions, I wanted to go over a couple of other tools that I use that I think are really fun. I'm not here to give you guys tutorials on how to use MACD and RSI and stochastics. That's certainly not my area of expertise. I know enough to look for, some gaining strength or, divergences or, hitting extremes. There's another tool that I built using the Motive Wave software. You can build some of your own instruments and indicators. And one of those I call the CAB PCR. CAB stands for Cow A Bunga. When I first started at Elliott Wave Trader, I was working for a firm that had rather strict compliance, so I couldn't use my name, and I posted anonymously as Cowabunga. Like Bart Simpson and the Ninja Turtles surfing the Elliott waves. So this is a version of a put-call ratio. I know a lot of people gripe about put-call ratios, that there's a lot of signal noise. My version that I built here just is not something that I use at a granular level. It is based primarily on a relative dollar value. So not actual numbers of calls relative to puts. And it's more of a dollar value. And I just look for it to hit certain levels of extremes. So the purple here is the signal line for that. A 2.0 level is the first extreme level that I gave it, of where puts are greatly valued relative to calls in an extreme. And then into the 3+ region is even more extreme. That is often very significant for potential bottom forming. And at least a lot of times you're going to get a pretty significant bounce off of something like that. And then the 0.4 or maybe even lower region is where I start to look for things starting to get frothy. Where calls are at a more extreme valuation compared to puts, and that we can start to see some weakness. So, again, I find this is a tool that I find much more useful for looking for extreme bottoming signals for the market when it hits the high region. But sometimes hitting this lower level can be some near-term frothiness as well. Which we certainly saw with a little bit of a retrace here when we topped in what looked like the A wave after a 3-wave move up, a consolidation, and then a 5-wave move higher to a measured move for that A wave, and just the A wave of this larger bounce. Then we got a nice corrective consolidation into our ideal Goldilocks fib zone, and are now set to start the C wave in that swing. For trading platform, I just saw a question here while I was looking at another screen. I use interactive brokers for futures trading, and to get access to stuff on the Canadian and maybe Australian markets a little bit for our metals and mining service. But I also use Schwab for most of my retirement accounts, because that makes it a lot easier. So I don't have trading integrated to my analysis charts. I certainly will zoom into smaller time frames, but I'll also look at like the 3-minute and 5-minute charts if I'm trading ES futures or ES minis. I like to do smaller groups of the ES minis, so I can layer in 3 of those at a time, or 5, and rather than having to just be 1 or 2 full ES contracts, and these are either all in or all off. This kind of allows for layering, which is what we like to do with a lot of our stock positions as well, because you're looking at these from different magnitude degree moves. So we're saying, all right, we have a couple of regions of support. So we can get to the first region and we can buy our first tranche. We can get to the next region of support that allows for a little bit deeper and buy another tranche. And we can have our stop set based on risk reward for the move that we expect somewhere below that. And then we can look for that smaller degree, 5 waves up, to in a corrective consolidation as a wave 1 and a wave 2, to start to look for that support to add, a third and maybe even a breakout tranche beyond that once it starts to break out in the heart of that move that's expected. Okay, the other thing that I wanted to look at, I'm going to actually switch over to the ES chart. And that is the parabolic support and resistance line, as well as the, I think it's Ichimoku clouds. I think that's how you pronounce it. Another just great tools that I like to use that, all of this can integrate really well. Oh, I guess I should probably, before I talk about that, I should talk about the moving averages and other things that I have on my chart. So we'll go back over here where it doesn't have all that noise there. So I have this red line. This is the daily, or if I'm on a time frame that's above a daily, then it's going to match whatever that larger time frame is. But at all daily and below, this red line is always going to be the 200-day moving average. The green one is going to be the 100-day moving average. The blue one is going to be the 50-day moving average. I also usually keep the Bollinger Bands, kind of in a shadowy gray on there, because I keep an eye on those, again, looking for those extremes when it lines up, when we have an ABC consolidation into Fib support, and we're also hitting the lower Bollinger Band and start to turn up off of there, that's some excellent signaling. Now going on to the parabolic SAR, that's these little blue dots. It's just a great additional tool to look for flips and momentum, and you can use it in lots of different time frames. I find it's a tool that's much better at a little bit larger degree. It's not something that I use on like a 15-minute or a 5-minute chart. But again, as long as you're holding, so, and it's remarkable as well how some of these other tools tend to line up very well with the Fibonacci expectations for a retrace or where resistance would be based on the Elliott wave. And so it just additionally helps to give you some more tools to look for confirmation. And so, we can say, okay, we just flipped over the dots at, whatever degree, trying to see, okay, here. If we get, we're already bullish on there. We flipped over. Okay, all of these have flipped. So we're bullish on a lot of different time frames as far as the blue dots are concerned. But that would change. The daily would lose that bottom dot as far as the support dots on a break of 39.12 at this point. And that fits with, we're counting at the subwaves inside that C wave to the upside that we're looking for, targeting the 4400s. We have this 5-wave move off the low and what looks good as all of a wave 2 and a strong turn up off of that. So a break under that level would at least be a wider and maybe deeper version of this circle wave 2, and could be the very first indicator that maybe this wasn't actually 5 waves up. Maybe this was an alternate of a circle B wave, and this was the A, and we're going to get a wider flat for the B into the lower 3700s, and then retry for the C wave up. Or maybe even, something that doesn't look very reliable from the price action that we're seeing here and so many other things, but that there are ways of counting this as a more bearish top. So if those first smaller degree levels of support might start to show signs of weakness, then you can start saying, okay, what else could this be if it's not going to hold the fractal pattern at the smaller degree for what we expect based on that Fibonacci pinball. The green and the red clouds here are just, the Ichimoku cloud. Again, it's a really good tool, I think, for different types of support and resistance. And again, I think we might be able to get through that cloud pretty soon. We're starting to enter it, maybe poke over it, pull back to support, and then that might start to really look, particularly for people that might only be looking at the clouds on like a weekly time frame as their signal of what's a real bullish move. They might view a breakout past the cloud, a retest, and then a strong turn up as the signal that we're off to the races to new all-time highs, where the Elliott wave context is going to say, hold on, not so fast. This looks like we have 5 waves up into a pretty high confluence of Fibonacci resistance that we need to look for that to be, we need to be on the lookout for signs of weakness. We need to start protecting our gains and tightening up our stops and saying, all right, where's the first indication lines of where the very first levels of support will break, where we can say this could be the start of something more bearish, or is it going to hold and start to move higher? One other thing that I wanted to jump to in terms of other tools that I use at different time frames. Oh, I thought this would be, oh, okay. So on this tab that I call Nano Counts, I have this is a tool that I borrowed from Carolyn Borden, who's a contributor an analyst for ElliottWaveTrader.net and has a service there. This is an 8 and a 34 period moving average cross. And so that changes, it's whatever period the chart is on. So right now it's a 15-minute chart. So all these green and red triangles are points where the 8 period has crossed over above the blue line, which is the 34 period of that moving average. So it's I think it's an EMA. So then when you zoom out a little bit further, then you get fewer of those crossover points at a larger time frame, but it's just another signal to use in conjunction with the context for Elliott wave of saying, okay, that looks like it has the potential to get some legs and being a very bullish move. Another tool that I use, and some of these I keep them on separate tabs. Sometimes I have the count replicated on the smaller tab, and sometimes I don't. But again, I try to keep, when I'm looking at something, I don't want to look at too many different things at once. I like to consult with lots of different tools, but I don't want to crowd my chart with too much data that I'm getting information overload. So this is what I use for the smallest time frame charts, even though I have that nano counts tab. I don't use that as much, use the micro counts. So that's the entire wave count at all of the degrees replicated onto this tab, but I'm zoomed into much smaller time frames looking at all of the subwaves at the smaller degrees. And on this one, in addition to the other indicators that we've talked about, I keep the VWAP on here because this is what I'm usually day trading ES in addition to managing my portfolio based off of this time frame chart, or even dropping down to 1 minute and looking there. And so that is a good indication for support and resistance as well, particularly when you test it and then leave it behind, that you can get those bullish trend days, even if it says a reversal off of a lower low. I joked on Twitter earlier that for those of you driving home, the S&P was largely unchanged today, but those of us who are in the trenches, know that we got this move down into our 618 retrace, the rest of the move down that we were expecting from the highs yesterday for the rest of that wave too, and then had a nice strong reversal off of that low at this smaller degree. I think that is pretty much everything that I wanted to talk about. So we'll I left you guys a few minutes for some questions. We also try to just have fun with it too. Garrett and I, well, maybe more so me, I'll make a lot of movie and music references. In our service Stock Waves, we also have a tool that allows people to make requests in a very robust database of analysis that's constantly being updated. So you can search by ticker and see some of those very up-to-date charts. So David, it doesn't look like there are any questions yet, but unless you have something for me.